Okay, folks, we're going to do a lesson on market structure and market maker buy models and sell models. And I want to incorporate some, I guess, top-down approach, trying to give you an idea of how you can take the tools that you're learning in the core content and mesh them together into a comprehensive top-down approach, and then understanding also the hierarchy of what tools you reach for, in what order, their level of significance, how it may or may not diminish through time frames, or that it may be more significant as we go through other time frames. So this is one of those lessons that, in my opinion, there's a lot of lessons that you get in the mentorship. They're just good. This is one of those lessons that are just simply worth the entire cost of the entire mentorship. So you need to revisit this one a couple times, because I'm going to be doing a lot of assumptions that you have worked through the core content, and naturally lessons like this are going to stimulate new questions in your mind, and that's good. But you have a study journal for that, and you write down your questions and your concerns, and then as you learn more about things throughout the content or new lessons, it'll start to become clearer to you. Okay, so again, as I mentioned before, some of the lessons that you're going to learn aren't going to be derived by simply me showing you something the first time, and it may require, and you'll find this true in many cases, that some of the things that you're hung up on, they will become clear because you learn something more or new that you may have never imagined had a direct link to the thing that you're stumbling over. And that's why 90% of the emails that I get, I always say, look, you'll get that answer in the future. And for the impatient folks, that just seems like I'm kicking the can down the road or blowing them off or something to that effect. It's hard for me to articulate it that easier than just saying you have to trust this whole process, because you can't understand what it feels like to ride a bike until you go through the motions of having someone hold the bike, after the training wheels, and then falling down and skinning yourself up and realizing you're not really dying. It's not fun to fall off a bike, but it's a process. But you still have to go through that, and some of you just don't want to skin your elbows up, and that just can't happen. It doesn't work that way. Everyone has to go through the growth. Okay, so I said we would focus on the index futures, and here we are. So here's the E-mini S&P and the June delivery contract for 2020, and we have a chart trained in on a 1 hour basis. Now, this is not limited to index futures. Okay, so the majority of what I'm showing you in this lesson is universal across all asset classes. Okay, but it'll help frame how your mind should interpret and internalize from a general standpoint. Now, obviously, every one of you are going to have your own unique price action models at the end using the core content. You'll all have things that everyone, if we sat down in a room and said, this is what I trade, I use this, you would all agree that you're familiar with those things, but you would be pleasantly surprised to see how everyone else is using these specific concepts that I'm teaching you here in their own unique way. And it sounds far-fetched. It sounds especially for the new folks. If you're new, it just doesn't seem like, no, it can't be the way it happens. Like, everybody should be doing the same exact thing. And that's the beauty in this, because when folks come here or they run into me and they see how powerful the things are that I teach, the natural assumption is, oh no, now that he's made this public, it's going to stop working. When you really understand what you're learning here, you'll see quickly that that is a fallacy that you shouldn't ever waste any time worrying about. Okay, if I honestly believed that anything that I've taught in this mentorship or have yet to teach would stop working, I would have never started teaching it. Okay, I mean, let's be real honest. If its effectiveness hinges on the fact that only I know about it, does it make it a market truth then? No. The fact that I'm revealing it solidifies and confirms that it's a valid truism, and it can't be undone simply because a lot of people know how to do it. A lot of people know how to do a lot of things. It doesn't mean that everyone that picks up a golf set is going to be Tiger Woods. Okay, it doesn't work like that. So anyway, the E-mini S&P here, we're looking at the hourly chart, and I want you to take a look at this. Pause the video for a moment, kind of look at what you identify in the chart, and then I'll add some lipstick. All right, so we're going to take a look at this here, and I've given you a lot of things, and this is what I would have in my study journal. This is what I would have in my I draw this out though, so everything you see here as this would kind of look like this. I sketch something like that. Okay, and then every turning point I just write down the number of the price. That's what my study journal look like. I prefer rather, the high touch versus the high tech. This is, again, a suggestion on my part to kind of like provide an example of what my journal entry would look like, some of the things that I would have, and how I go through the process of recording events either I've partaken in terms of trading, or observations I want to keep fresh in my mind, so that way next time I go and look at the charts, before I sit down and look at any new charts, I look at my last 2 or 3 journal entries, and I want to get a feel for what I was seeing. Do those things still hold true in the market, or has something abruptly changed it or challenged it to a degree where I have to kind of clear the charts and go back in and look at it from a fresh perspective. Now, if you take a look at what we have, you can see quickly that we have a volume imbalance in here. So all this is an absence of any candlestick bodies. Now we get a delivery of buy side here, and we get a delivery of sell side, and back and forth, and then we have a stop run. Now, if you remember the previous lesson, we talked about how the market moved from this area here, showed a breakaway gap, and doesn't want to come back up and rebalance this area here. Okay, and that's what you want to see. You want to see those types of things occur when you understand or are trying to forecast a narrative that should be unfolding in price. What should be unfolding here? Well, the blue shaded area up here, that is the volume imbalance on the daily chart for the S&P June contract. So we were anticipating the market trading up into that, showing some willingness to trade lower, because after it rebalances, then it should want to go lower. And we waited for the market to show us that it wanted to do that, and it broke down. And again, if you didn't watch the previous lesson, stop this recording, go watch that one. Or if you don't really recall the major tenets to the previous lesson, go watch that one again, and then come back to this one, because then you'll get a little bit more detail, and there'll be more symmetry. These lows connected out in time, I like to see that occur, and I mentioned that in previous discussions about the E-mini S&P. And when we have a consolidation like this and the expectation that the market should run for a discount array, in this case here, the lowest one would be the old low sell side liquidity pool. And I gave you several other examples in here where you could reach for downside objectives, but the logic was, if this in fact was a daily volume imbalance that should send price lower, what was the price swing that started it prior to it coming up into it, which was this low here? We do have a volume imbalance in here, and you extend that out in time. The market does trade down, and it purges the sell side liquidity right below this low. Now, there's a difference between the terms purging and raiding. Okay, so you can see up here I have the annotation buy side liquidity raid, and then a sell side liquidity purge. When there's a purge, okay, when I say it's a purge, or if I'm referring to it as a purge, that means it's usually a very definitive turning point where it kind of like completely washes out that side of the marketplace or traps those individuals, and then it goes the other direction. In other words, it's a significant or intermediate term change in direction. A raid is simply a run to a pool of liquidity. That doesn't necessarily mean that there's going to be an intermediate term reversal. It just means that was an objective, and it either consolidates and then continues going higher, or it waits, or we as the trader wait for more information to see if it does in fact want to break down. Looking at this chart here, it certainly doesn't appear as it wants to go lower, and this was simply a near-term objective. So we do see a market maker sell model here. You may not recognize it, but it's there. And then we have the market maker buy model, which we're going to flesh out in this lesson here, and also work with hierarchy of the concepts and how to ring things in. But before we get into it, I want to talk a little bit about the concept of accumulation and distribution. How can we look into price action without the distraction, okay, or confusion that's introduced by utilizing indicators? We don't want to look at things like these trend lines, because the retail universe, they would expect this area here to offer what? Diagonal support. And that's what that little eyeball there is, to remind me to talk about how this is where retail expects to see a buy. They see a bull flag. They see a rally continuation after the consolidation higher, ABC D pattern, that type of thing. That's all failed logic. The blue shaded area is the real narrative. That's that daily volume imbalance I talked about well in advance before we even traded there. And now that we traded there, you can see the effects of it. Now, as I mentioned in the previous lesson, I talked about how this area would be a run on liquidity or draw on liquidity, and the market does in fact trade down there. The purging of that sell side liquidity sets the stage for a potential smart money reversal. Now, why and how would you know that? How would you go forward using what I'm going to teach you here in this lesson to use it for determining if there is a run below this low here? How do you know, Michael? Okay, because I get this a lot. ICT in the email. I love everything I'm learning, but how do you know, or how can I know when a previous low is rated, and if it's going to be a turtle soup or if it's going to be a continuation? I'm afraid that if I take the trade, I'm going to get stopped out. Well, here's the thing. You're going to get stopped out a lot until you understand what you're looking for and what it looks like. Again, the journaling part is just the beginning stages of it. It doesn't magically transform into, because you collect a lot of examples, then all of a sudden you know how to do it. It will slowly progress to your understanding. You'll see it over time. I can't make it faster for you. No one else is going to teach it faster for you. No one's going to make it simpler for you. That's those growing pains that every one of us have to go through. And the easiest way to do it, and the way you shorten the learning curve, is to take copious notes and record your charts like I'm showing you here. Now, you don't have to be as textbook as this is for me. Like these are the things that are salient to me. You could do something even simpler just by saying, this is a stop run and it should go above the equal highs up here. But for me, when I'm looking at price, I want to see every area where retail would expect one thing, and how I understand that my concepts can invert that and see the other side of it. Remember, it's that market efficiency paradigm shift that's required to see what I'm teaching. It attacks retail logic. It takes the perception of what retail traders see with indicators and supposed chart patterns, all those things with their support and resistance theories, they are weapons that are used against them, and they don't even realize it. But that's what I'm teaching you. I'm showing you how the markets chew that up and eat their lunch. But what do we know about this low here? Well, we ran below the low here. Great. But let's take a X-ray view of what's really going on as the market trades down there. So if you look at the E-mini S&P, and this is a 4-hour chart, this is going to help me communicate the underlying narrative. All right, so you can see the E-mini S&P, and we're making that lower low here, and the green line here is the NASDAQ, okay, and NASDAQ index futures, and this is the Dow futures contract. All of them made lower lows. You see that? So from an SMT or smart money tool or smart money technique, that concept wouldn't readily jump out at anyone. But you have to look at market structure, not just the individual independent lows. You don't need to, you're never going to see it just as simply looking at old lows relative to the newest one. Okay, it isn't going to always jump off at you. You have to look at the underlying market structure. So from this point here, if you're sitting at your desk, okay, or your computer, stand up, walk to the other side of the room, and then look at your chart. And then look at the far left side of the chart. You see where price was over to the left? Over here, right? So where are we in regards to, at this low, to where price has been? What has been going on? It's been going higher. I don't need a trend line to do that, to communicate that. I don't need a moving average to show that either. Okay, so the market is in an underlying bull market on this 4-hour chart. That's all the sample size you need, because all you need to know is what's the next price leg. And if you're using a 4-hour chart, that can give you a very short-term perspective, and many times you can just use the 4-hour chart to get a one-shot, one-kill scenario for a weekly range. But you have to look at the underlying market structure. You can't just simply look at these two lows and say, okay, well, there's no divergence there. So you have to look at the market swings within the present market structure. And what is that? Well, you have this high here, you have this low here, you have a high, a low, a high, and then we have these lower lows. This low is lower than this low on the S&P. Notice that? Respectively, we have the low in the Dow futures and the lower low as well. So E-mini S&P and Dow made comparable, equal lows. Not in the sense that they're equal, but they moved to lower lows in the same capacity. However, look at the NASDAQ. Its low is here, and then the NASDAQ low is up here. So which one is the relative strength leader to the upside? If you're looking to be a trader of index futures, you want to be trading the NASDAQ futures. Now, all three should go up in sympathy, but if you're going to predominantly trade one index future, then how do you use that information? Okay, say you don't want to trade the NASDAQ futures. Okay, fine, no, that's not a problem. But you have to take the information that it's providing you and then to understand what is it showing you in price. Well, that means that this low here is simply just a turtle soup or a false break to the low, and it's not going to go lower, and it's going to go higher. When you have that criteria, or you see the signature in price, you go to your E-mini S&P chart, and then you say, okay, this is a potential reversal in the making. And I understand that the NASDAQ futures is the stronger one to be trading. Its relative strength is on the upside because it's unwilling to make that lower low like the Dow and the E-mini S&P did. That is not, or what I'm about to show you, is not Dow theory. Okay, Dow theory helped me understand what Larry Williams was teaching in regards to a concept he's shown in his 1970 book, How I Made $1 Million Trading Commodities Last Year. So if you don't have that book in your library, you absolutely should get it, okay? Because the way he talks about in that book, how he looks at price and he compares like what contract should he trade, what contract month, and what market should he look at by comparing like markets. And no one accuses him of saying, you're just talking or renaming Dow theory, okay? And I took what he described there and then amplified upon that. Now, I personally believe he was inspired by Dow, or the theory of Dow, looking for the averages to confirm one another. He doesn't really come out and say, I did this, okay? But, and again, I'm not trying to kick sand in his face either. The idea of what I'm suggesting to you here is how I evolved. And yes, just because you see a rectangle on my chart doesn't mean it's a supply or demand zone. Okay, it's me explaining a narrative. Okay, there's not always going to be something out there that has inspired me. There's going to be things that I'm going to teach you, and when I tell you it's mine, it's mine. Nothing else really, helped me along. The Lord did, obviously, but I didn't use someone else's things when I say this is mine. Okay, market maker buy model and sell model, they're mine, and they don't agree with the Wyckoff theory. Wyckoff's too myopic. I agree that there is some significance or importance that you can glean from that, but what I do with the market maker buy and sell models are absolutely precise, and it provides the logic. It gives you the underlying understanding that you can use for classic support and resistance, like what levels would be support and resistance. So I'm going to kind of like touch on those in this lesson, but kind of like break it down even further for how you can use what I've been showing you on the YouTube channel, so I can bring all that stuff in together. But we have the likelihood that this is a potential market reversal in the form of a smart money reversal, which is the low end of a market maker buy model. Okay, so the ICT market maker buy model, the lowest of that model is always referred to as the smart money reversal. Only the smart money sees this coming or trades at that level. Then when the market trades up and gives you your first buy signal, this is going to be your first accumulation where it's a low risk buy. What you need to understand in this chart is what I'm showing is this volume imbalance. We extend those things out in time. They're not supply and demand zones. Okay, they're not. These levels are superior to any of that stuff. Remember, supply and demand, they don't want to cut through candles. We absolutely have to understand cutting through candles gives us the narrative, because this is just a stop run. So if you erase all of this price action, okay, take all this information out of the chart, disregard it, pretend it doesn't even exist, what are you left with? Now, if you're watching TV, ladies, if you're doing your nails and you're not really paying attention, stop. Because what I'm about to show you is going to blow your mind. It's going to literally jump off of the chart. But you have to be paying attention to understand it and appreciate it. If you have a market maker buy model, and the same thing for a market maker sell model, just everything's being reversed here. When you see this event here, this is the stop run that takes out an old low, and then the logic or the narrative that this eventually run out an area that was original consolidation, where the buy sell liquidity rests above that. So in other words, it's the original consolidation. We leave the consolidation, we return normally, but when there's a breakaway gap, we don't need that. Distribution, and again, if you haven't watched the previous lesson, you'll understand there why this is a breakaway gap, and I'm not going to repeat it here and burn up more time. The market breaks down, trades into the volume imbalance that's over here, consolidates in it, and then breaks lower finally after crouching above this old low. Now, take this Judas swing completely out of the discussion, because that's the manipulation. What's going on here? You're accumulating inside of the volume imbalance. This accumulation is going to be met with what? Manipulation. What do you mean by that? It's going to manipulate the thoughts and sentiment idea of the market by dropping out of it and running this old low. Logic from the retail level says that that is a support now broken. So traders going to see that as a reason to be short on a breakout, or anyone that's long back here that's been holding on for a long time, their stop is now gone. Because natural progression would be their stop has been raised here, or maybe it was raised here, and they have eliminated them and neutralized all of them. This in here, this consolidation, is engineering more liquidity underneath this low, because traders see this low likely holding because it can't go lower. Individuals that are seeing a bear flag in here, they may be going short and they get this little tiny little run here. And where's their stop going to be? Above this high here. So while they have short-lived paper profits, it quickly rejects on them and they don't get to make any money either. So back to my discussion and point. Take this swing out. Ignore it for a moment. Pretend it doesn't even exist. You're left with this low and the market rallying up to here. You see that? Now watch. We're getting ready to jump light years ahead. When I look at charts, I look at things that aren't in the chart. In other words, we see this move here and no one is looking at what I'm about to show you. You don't see anyone teach this. It's not anywhere, okay? But it is a higher order of market structure. Watch what happens. I'm going to take this low, carry it up to here, to this high. So you can see price trades down into this optimal trade entry area. So you can be a buyer there. This and this low, so your stop could be below this low, not this one. The reaccumulation that's occurring here, because we originally see smart money accumulating here, they'll ride this stop right down. This rate on stops, it doesn't affect them. And then the market moves in their favor and then comes back down and finds the top of that volume imbalance over here. So that it returns back to the original consolidation that's accumulating new longs. They manipulate anybody that's in the market out, scare them out, okay, and create new liquidity for sellers at a lower price so they can pick up more orders down here at an extremely discounted rate. The bulk or the majority of their entries is here. Not very many are being accumulated down here. They're taking their time, adding more and more and more. Then the run down here just gets these orders below this old low just for an additional averaging of their order or averaging their price. The low to high running back down into optimal trade entry, that's what makes this a low risk reaccumulation. Your stop only needs to be below this low here. Notice also there's no volume imbalance, there's no fair value gap, there's nothing in here. It's all rebalanced back and forth, back and forth. So this entry here, at the top of the volume balance or at the order block, that's what that plus OB is. It's saying all this down here becomes the order block. The redistribution area becomes your reaccumulation for longs. So it becomes a mitigation. So the extension that we see below this consolidation that runs below this low here, it's a Judas swing. Just for the sake of this discussion, just ignore it for a moment and think about this price low to this price high. Because the narrative is this: they accumulated, then manipulated, and then they start distributing profits up here or taking some of their position off. And then as the market goes down, what are they doing? They're going to reaccumulate more longs. Why? Because they're at an area where they had accumulated before. So if this is indeed a market maker buy model, all of the liquidity that's resting here is going to be the target. But they're accumulating longs in here, down here with the introduction of a stop run. So this running of that low here floods the market with sell stops. So if the market has an abundance of sell stops, it's a wasted event unless smart money goes in there and pairs their buying up with it, making them long from here, long inside of the volume imbalance, and then the market structure break here breaks down into the accumulation again. So the volume imbalance is going to support price. This is your optimal trade entry. Doesn't look like one, does it? But it is. So in this area, we're going to take a look at this on a 5-minute basis too, but just for now, I'm going to kind of flesh this out some more. Then we go to this high. So the market runs above that, and then we go to another area of reaccumulation. Why? Because this was an area of distribution. This vertical line here that's dotted, this is the curve. Everything to the left of the curve on a market maker buy model is the sell side of the curve. Everything to the right of the curve is the buy side of the curve. So everything that you see on the left side, which is the selling points, they will match up on the right side for buy side. In other words, every sell here will become a buy on the other side. Sorry, folks, but that's just simply not Wyckoff. Okay, Wyckoff wishes he knew this stuff. Okay, bottom line. So the market goes down into an area of reaccumulation, so that's another buy. This buying point sends price up into the buy side liquidity resting above this individual consolidation. So we have a completed market maker buy model inside of a market maker sell model. But I want to take a closer look into this area here and show you how all this stuff works down into what I've been sharing on the YouTube channel. So I've been teaching the Optimal Trade Entry Pattern Recognition series, which is simply just doing the exercise of going into the market, capturing, if you will, individual daily optimal trade entries within the New York session, 8:30 a.m. to 11 a.m. New York time. So in this area here, we can see the narrative. And the narrative is implying that the market should be making a market maker buy model, and it should rally up. From this point here, where should it rally to next? Think about what I teach you. Where's the near-term draw on liquidity? Right above these relative equal highs. That's your near-term buy-side liquidity. Then above that, it's this one. Then above that, it's this. The underlying bias is that the market should work every day towards running this area here, the buy side, relative equal highs and the original consolidation. Where it's trading here, we have to take one leg at a time within the market structure. The market structure of the market maker buy model is not just from low straight line up. It doesn't work that way. You have to refer to the points of the sell side of the curve. So all these points where it made highs and sold off, made highs, sell off, those individual points are going to be real, quote unquote, support and resistance. So if you have the understanding and the narrative that's in play in at the moment when you're looking at a chart, then you can go in there and use those examples everybody puts in their books and says, look, here's where the old high is broken out, becomes support, or the old low is broken, becomes resistance. And it just seems like it's so easy. You can go out there and start doing it in your charts until you realize that you're losing money hand over fist and hemorrhaging money constantly. But yet everybody else seems to understand what supply, demand and support and resistance and all these other things that people write books about. But why is it that none of these people are able to make money with it? And I'm sure there's 1,000 people online, okay, and they're all saying, oh, ICT, we're just not online proving it because we have better things to do. No, you're in fantasy land. Okay, that's all fantasy. The markets operate like I'm showing you here. They move from one point of liquidity to the next. And if the liquidity is not sufficient enough, it will be engineered. Okay, that's it. That's all there is to it. That's all there is. And it operates on the basis of time and price. So the mechanism or the life's blood, okay, of the market is liquidity. Without liquidity, you have no market. The heartbeat, okay, being the presence or engineering of liquidity, the muscle, okay, that moves price around is time. Okay, it's time. When you look at time, this pattern here is in the hourly chart. So inside of the hourly chart, all of the mechanisms relative to liquidity and time and price will be operative on this time frame until it completes. But understand, remember what I said about this low here relative to this low. Whereas the NASDAQ futures made higher low here, whereas the Dow and S&P made that lower low. It does not mean that the S&P or Dow can't rally. It just means that the crack in the correlation between all three averages highlights the greed that their level of order entry, that the sheer order size that was coming in the market at this very point right here, when we looked at the NASDAQ, It's a huge accumulation of buying going on in that. That means there's a lot of tech stocks. And if you look at Amazon, like I mentioned before, that's a stock that's proven that with everything else being closed, everyone else is going there. And I've admitted that I've done that too. I've spent thousands of dollars already. I've probably spent 11 grand, buying things through Amazon since the first week of February. Now, this point in price, that's the underlying structure that supports the narrative that inside of that hourly chart, all of these things should be true. Because if we can spot that pattern, okay, the consolidation we break down, run to stops, this could potentially see a reversal if we have things like I just outlined with the index SMT, which is the SMT divergence between the Dow, the NASDAQ, and the E-mini S&P. If we look at this little area right in here, okay, since the market has traded down to an area where it was distribution before, now it becomes what? Accumulation. It's an optimal trade entry when we get rid of the manipulation aspect and look at the underlying pinnings of the market. That's this low to this high. You get an optimal trade entry right there. It's also supportive with the volume imbalance that's shown here on the hourly chart. So now, the 4-hour gives us our framework. Are we a buyer or seller? The setup is the market maker buy model. In this box here, we're going to break it down even further and bring in what I've been teaching you and everyone else on the internet for free, the optimal trade entry. Okay, we're going to go right down into the 5-minute chart. And here it is. Isn't it obvious? Look at it. I'm being facetious. Look at it now. Here's your low to high, optimal trade entry. And it trades again right back down. Look at the bodies of the candle supporting the idea of that volume imbalance. It's beautiful. We have a little bit of a wick or tail, but the bodies are saying what? We're not allowed to trade down inside that volume imbalance because it's done its job already. Then the market does what? It rallies, breaks the short-term high here, and then this last up-close candle acts as a mitigation block. So everything that used to go short here to be counterparties to, they have to take those off. So how do they do that? Inside this area here, we have multiple optimal trade entries, fair value gaps, and bullish order blocks. And every time it comes back down, they mitigate. So anything that was short, they sell and buy more. 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 Off to the races. We run this high here. So everything that you're learning, here's your New York session, 8:30 to 11. There's your optimal trade entry. You have a breakaway gap in here. You want to see that. You have a institutional order flow entry drill right there. You can get in long there. This should stay open. The market comes down, touches the top of that gap again, rallies. Fair value gap, fills it, rallies. Bullish order block, trades into it, rallies. Fair value gap right in here, trades down to it. What's it do? Rallies. And then ultimately, this explodes and goes to the upside. Further and further, another area of reaccumulation. And then really explodes back up into that daily volume imbalance and runs up to it and eventually through its old daily high. And then there you go for your run on the buy side liquidity raid. So in this video, I showed you how we can take the macro view of looking at a 4-hour chart, which, wait a minute, that's not a macro view. It is to me. 4-hour is in the same classification to me as a daily chart because they can both give me what I require for a one-shot, one-kill or short-term trade. But the 4-hour gives us the underlying bullish or bearish bias rather. And if we see modes of accumulation, as I shown with the accumulation that's not shown in the higher low here with the Dow, the NASDAQ higher low, And then we saw clearly the lower low relative in the S&P. But the leadership or underlying leadership of the strength to the upside is seen in the NASDAQ. That's why anytime, if you look in the last week or so, the NASDAQ stocks have been the one that's been leading the upside on the stock movement. So all of the big movers to the upside have predominantly been NASDAQ issues. So you can take this information and do a lot of things with it. We don't talk a lot about stocks, but we're going to obviously be bringing that in. If you're going to be day trading or short-term trading stocks, this takes you right into, okay, now I have to be looking at the NASDAQ 100 and which stocks in there are operating very similar to what I've shown on the S&P, where you can see and map out market maker buy models. And then you can do stock options, either in the money or out of the money, depending upon if the implied volatility is low. And I'll touch on all that and teach it, and we'll get into all that stuff. But the point is the things that I'm showing you here, don't just look at them and say, well, it's a hindsight example of something you didn't talk about beforehand. I couldn't trade it because I'm not going to trade the S&P anyway. And you're just abandoning it. You're throwing the baby out with the bathwater. And that's just silly. I'm teaching you how to look at the market and decipher what it's showing you. And then I'm also reminding you that you can take this signal here and say, okay, I want to be a short-term trader for the next week or so and trade NASDAQ stocks that are showing relative strength to the upside and have market maker buy models. And then you can trade stock options or the shares if you feel inclined to do so. But I personally wouldn't do that. But you can take this information also and combine it, or apply it rather, to Forex. The green line here could simply be the dollar index, and this could be the British pound. And you would look for a USDX SMT divergence or a correlated pair SMT divergence. And the same thing, the same logic would still be here. And then we go into the E-mini S&P chart, and this could simply be a Euro chart. And it's all applicable. It's universal. Okay? So hopefully you found this lesson insightful. Obviously, we'll be teaching more on this type of thing, but market structure within the proper context will unlock everything. And I've shown you something that's a higher order of market structure today with the optimal trade entry that isn't taught, okay, outside of what we're seeing here, because you have to know what you're looking at. And when I say I look for things that are not in a chart, you're not going to see the chart or draw a fib like that. No one's doing that. No one's doing it. But if you go back and look through your charts and see where lows that form like this, it's uncanny. It's there like 90% of the time. It's almost like clockwork. And it's not just in S&P, and it's not just in Forex. It's in all kinds of markets, every asset class. But the point is we've moved in from a higher time frame perspective. I applied bias, underlying SMT divergence for accumulation and distribution. I've shown the application of accumulation, manipulation, and distribution. I've shown you how to see optimal trade entry outside of the scope of the point of manipulation. This area here, take that out. What are we left with? This low to high. There's your optimal trade entry. And it just so happens it overlaps with everything else I teach you in the core content. That's not random. Okay, that's not random. And I would have never seen this had my eyes not been open to it. Not by a man, not by a book, but through prayer. Hopefully you found it insightful. I'll talk to you again on Wednesday. Until then, I wish you good luck and good trading.